The most powerful force in Bitcoin right now isn't miners, isn't a trader, it's a BlackRock. Their Bitcoin ETF is closing in on $100 billion in assets. And if you think that's just another headline, you're missing the real shift. This is not about the money, it's about control, supply, and the future of Bitcoin liquidity. Let's break down what's happening, what it means, and what comes next. IBIT, the iShares Bitcoin Trust, launched in January 2024 when the US finally approved the Bitcoin ETFs. Unlike older ETFs, IBIT is physically backed. That means every share is backed by real Bitcoin held in custody by Coinbase. This gives institutions what they've wanted for years, a regular, easy way to get Bitcoin exposure with BlackRock's name behind it, no wallets, no keys, no exchanges. Within months, it broke records. And now, less than 2 years later, it's about to cross $100 billion in assets. IBIT growth wasn't just fast, it was unprecedented. In the first 30 days, IBIT gathered more inflows than any other ETFs in US history. You're probably asking why. Institutional demand, pensions, endowments, RAIS, they were waiting. Macro environment, inflations, fiat distribution, and Bitcoin crossing $100,000 creating urgency. Momentum loop, inflows pushed Bitcoin price, rising price drew more inflows, and repeat. At one point, IBIT was buying more Bitcoin per day than was being mined. That's not just growth, that's absorption of supply, and it changed the game. Now let's talk numbers. IBIT charges 0.25% annual fee on $100 billion, that's $250 million in yearly revenue, making IBIT one of BlackRock's top earning ETFs, surpassing many legacy funds. Now that tells you something deeper. Bitcoin is no longer a niche product for BlackRock, it's strategic revenue stream. Larry Fink himself, once a Bitcoin skeptic, now says crypto is a global asset class with long-term institutional adoption. The narratives have flipped. Here is where it gets more interesting. IBIT and a few other ETFs now controls over 900,000 Bitcoins, that's over 4% of total supply. And the majority of the Bitcoins held in cold storage of exchanges unavailable to trade. This creates structural scarcity. While miners produce about 900 Bitcoins a day, these ETFs have been acquiring at rates of 2x to 3x that, especially during surges. And now with 2024 halving cutting block rewards into half, supply is even tighter. When supply shrinks and demand stay constant or rises, prices respond. The next rally might not be fueled by hype, it could be fueled by supply mechanics. We're entering a new phase for Bitcoin, one where price is increasingly tied to ETF flows, not just macro news, not just sentiment. And now that has some pros and cons. The pros of that are border adoption, price discovery through regulated market, and more stability and transparency. But the cons are Bitcoin became entangled with its legacy system, retail may be crowded out, BlackRock and others now hold key to massive Bitcoin reserves. And you have to remember that Bitcoin was designed to be decentralized, permissionless, and censorship resistant. And now having the Wall Street own 5 to 10% of supplies raises a real question. Are we watching Bitcoin succeed or watching it being absorbed? BlackRock IBIT is about to cross $100 billion. That's not just bullish, it's transformational. A traditional finance giant now leads Bitcoin adoption and makes more money from it than most crypto-native firms. So what's the takeaway for you? The game has changed. Institutions now move the needle. You're early if you understand this dynamic before the crowd. Stay sharp, the next big move may not come from Reddit or influencers, but from ETFs flows and quarterly fillings. If you found this breakdown valuable, subscribe to Crypterial. Soon we will compare Ethereum ETF progress and whether Solana might be the next target for institutional inflows. And for you guys, stay disciplined, stay curious, and always do your research. I will see you in the next video.